Yes. Hi guys. So how you doing? Hope you got value from the last information we shared. And today we're going to be moving into the major participants in the forex market. We're going to be trying to know who are the participants, who are those participating in the market, who are those causing the market moves, the major moves in the market, who are those making the market to move the way that it does. All right. So today we'll be looking at the foreign exchange market participant who controls the market. Now, before we start, I want you to know that your a lot of people think that the broker is the one manipulating the market or other external factors, but I want you to know that the market, the forces that controls the market are the forces of supply and demand, and those that causes the market to move are the participants in the market based on supply and demand. So today we're going to be looking at the major participant in the market. But before we do, I want you to know that the financial market is the largest market in the world with an estimated turnover of over 6.6 trillion in 2019. As at 2019, it is estimated to have a turnover of 6.6 trillion dollars, right? So in the financial market, the US dollar is or was the most traded, followed by the euro and the Japanese yen, and is still the most traded right now, followed by the euro and the Japanese yen. The US dollar has the highest volume in the market. So having got that, so let's move. Who are the major participants in this market? So this participant, like I said, they are the ones that causes the market to move the way it does. Actually, if you really understand this part, you will really become a profitable trader because you will know who are the persons that cause the market to move the way they do and why the market behaves the way it does, and it will make you be able to adjust your psychology so that you'll be able to take trade, know the right time to trade and when not to even trade at all. So who are the market participants? The governments. I would say they are the first, the central banks, they are the second, the financial institutions. They are the third. We have the hedgers, the speculators, and we have the retail traders. So the major market participants are the government, the central banks, the financial institutions like your banks, the hedgers, the speculators. So we, the retail traders, we are just we are not the major participant in this market, right? We are participant, but we're not the major participants in this market. So let's move to the government and the central banks. Okay, the government and the central banks, they are the major participant in this market, and they don't come into the market to make profit. They have different reasons why they play in the market. Probably, for example, to regulate exchange rates, to set interest rates. They will have to intervene in the market to regulate their exchange rate for a particular country, to also set interest rates. So this causes the government and the central banks to participate in the market. And if you are going to be trading and in the financial market, you want to pay attention to the following events, the news events, because these news events can major moves can cause major moves in the market. The FOMC, you want to pay attention to the FOMC, you want to pay attention to the central bank rate decision, you want to pay attention to the GDP, you want to pay attention to the CIP, you want to pay attention to unemployment rates. All these news events causes great moves in the market, and you want to also pay attention to them. So let's move on to another major market participant in the market, which is the financial institution. The financial institutions, like the banks, are the second and one of the most important participants in the market. Now, I want you to know that they provide the most volume in the market that causes the market to move the way it does. The financial institution provide the most volume in the market that causes the market to move the way it does. The banks, they trade forex basically to make profit. All right. The banks also facilitate forex transactions for clients. As a trader, you should learn to trade like the banks. As a trader, you should learn to trade like the banks. I will advise that you trade with the banks. So how do you trade with the banks? When the banks are putting in orders, you want to know where they are putting their orders, then you want to trade with them. You want to trade with the institutions. That is how to be profitable, guys. That is the secret to Forex trading that I found, is that you trade with the institutions. Wherever the institutions are going, that is where you want to go. And if you are trading with institutions, because the cost is the major volume in the market, you don't want to trade when they are not trading. They are not trading during major holidays. When the bank is on holiday, during weekends, during major holidays, you don't want to trade in the market, right? You don't want to trade in the market, because the aim of trading is not just to have fun, but not to even have fun, no, but to be profitable. You want to be profitable trading Forex. So you're going to ask yourself, how do I, where am I going to stand to be profitable? You have to stand and trade with the banks. You have to trade with the financial institutions. Wherever they are going, you want to go, right? You want to go. So let's move on. We have the hedges. The hedges are, they are the next biggest collections of players in the forex market. The next biggest collections of players in the forex market, apart from the central banks, the government, and the financial institution, we have the hedges. So a forex hedge is a transaction implemented to protect an existing or anticipated position from unwanted moves in exchange rates. So it's just basically a transaction implemented to protect an existing position or an anticipated position from losses, unwanted moves in the exchange rate. So if you want to protect it from losses, you have to hedge. So like I said, they make the next biggest moves in the forex market. So multinational corporations trade forex to hedge the risks associated with foreign currency transactions. So multinational corporations that want to exchange currencies or want to trade, want to import and trade in different currencies, buy goods from other countries, they have to what? They have to hedge the risks associated with foreign currency transactions, right? So it is the header's job to protect companies from major losses while doing foreign trades. So when companies are about to do foreign trades, it is the header's job to protect them from major losses in the financial market. So the hedgers come in to protect them from major losses in the financial market while doing foreign trade. So we say a forex hedge is a transaction implemented to protect an existing or anticipated position from an unwanted moves in the forex market. And these guys, they are the next biggest collection of players in the market. They are part of the participant that causes the market to move the way it does. All right. So the next we have are the speculators. The speculators, they are sophisticated risk-taking individuals with expertise in the market in which they are trading. They are sophisticated risk-taking individuals, and they have knowledge in the particular market they are trading. They a lot of people come into the forex market to trade a lot of pairs. You don't want to trade a lot of pairs. You want to be able to trade a few pairs in the market. You want to master those pairs and make profit from them. Traders, they predict price changes and extract profit from the price move in an asset in extreme volatile conditions in the market. If a speculator believes that a particular asset is going to increase in value, they choose to purchase as much of that asset as possible. And when they do, this activity, based on perceived increase in demand, drives up the price of that particular asset. And if a speculator believes that a particular asset is going to decrease in value, they may choose to sell as much of that asset as possible. And the activity also will also there will be supply in the market that will tend to drive up the price downwards. All right, so let's move on. So the last participant we're going to be talking about are the retail traders or retail investors, and this is the category that we belong. The retail traders, we belong. Me and you that are coming to the market to make profit, we belong in this category. Now, we or the retail traders provide just 20% of the market movement, While these other participants that we've talked about, the government, the central banks, the financial institutions, the hedgers, the speculators, provide the major movement, about 80% of the market movement, right? So thanks to the internet, we can also participate in the Forex market. Before you can participate in this market, you have to come in with a lot of capital, and they have a lot of contracts that you have to sign before you'll be able to have access to this market. It's a long process, but thanks to the internet making it easier for you and I to be able to participate in the Forex market as retail investors. So as a retail investor, your job is not to try to predict the market. Don't try to predict the market. But what you need to do is to find the trends that are rising and the trends that are falling and follow them closely. You want to be able to find the trend. Where is the market going to? Now, if you see the market going north, you want to follow. If you see the market going south, you want to follow. If you see the market going is bullish, you want to just follow it closely. If you see the market coming bearish, you want to follow it closely. That is your job. That is how you're going to be profitable in trading the financial market. All right, that's how you're going to profitable trading in the financial market. Just follow the trend, follow price. And I read in a book, one of my mentors saying, follow price and money will follow you. All right, so these are the participants in the market. These are the people, or these are the group of persons that causes the market to move the way it does. So once more, I want to congratulate you for joining and also being a participant of this training. I hope to see you as we progress. Thank you and have a nice day.